Good afternoon, everyone. We're going to get the presentation started. It's a little after 2:30. I want to welcome everyone today. As you're all aware, I have with me today Brooke Thackray, who's a research analyst with Horizons ETF Management in Canada. Brooke is as I mentioned, a research analyst and joined in 2009 the team responsible for the management of the Horizons seasonal rotational ETF. He's a regular contributor to the Globe and Mail, Gold Line investor, and I'm sure many of you have seen him as guest on BNN. Today we're going to talk about his strategy on their approach to investing. And the approach is about seasonal investing. Depending on the time of year, there's opportunities that their team wants to capture. But at the same time, depending on that time of year, there's also areas that he wants to avoid. One of the most familiar sayings that a lot of investors are aware of is the sell in May and go away. They've got other sayings or ways to approach the strategy that Brooke's going to talk about, and we're excited to have him on board and talk about where they are at this point and see how they did during that period of May. So first of all, I've got with me, Brooke, we're going to dialogue here. Can you tell us a little bit about yourself and your team and your approach?
Sure. Well, thank you very much for having me on the conference call. It's a delight to be here, and hopefully I can give you some insights into our approach and also on the markets and maybe some of the sectors that are coming into play right now as well at the same time. So our team, there's three of us on the team. There's myself, just a quick background. I've written 7 books on seasonal investing. As Frank was mentioning, I'm on BNN. I write for the Globe Gold Investor. I'm also interviewed a lot in the press as well. Don Vilo, he was the technical analyst for RBC. He's got over 40 years experience with RBC, and likewise being on BNN and writes frequently in the news as well. John Vilo, his son, is also with our team as well, and he worked with State Street and helps John Vilo with some of his writings as well. I want to talk about seasonal investing, and it's something that people are becoming more and more interested in, and they're seeing a lot of value in this approach. So seasonal investing works in 2 ways. First of all, it works with the broad market such as the S&P 500, and also with different sectors of the market. So the broad market S&P 500, or the TSX Composite, same thing as far as seasonal goes, is those broad sectors have a 6-month seasonal period where they tend to do well, from October 28th to May 5th. On average,
so really this isn't about timing the market. I just want to make it clear with the listeners out there. It's not about certain timing. It's about the seasonality of where to invest at specific times of the calendar.
Absolutely. What we've done is we've looked at the analysis of when the sectors move up. We're not trying to time the market and say, I think that the market's going to go higher or I believe it's going to go lower. We've looked historically at the trends in the market, and we let those trends with statistical guidance give us some foresight into what sectors of the market we should be looking at specifically. And all of the sectors, whether it's gold or oil or whatever sector it is, tends to have a seasonal pattern, and what it is all of these sectors are driven by some causational factor, whether it's a supply-demand imbalance, or it's when sectors tend to release their earnings, or when they have their conferences. There's some sort of factor that reoccurs on a yearly event that tends to increase that sector at that time. It doesn't matter if it's the summertime, the fall time, the winter time, the springtime. There's all the different sectors tend to have different periods of seasonal strength. So does it work? There's been a lot of people asking questions, is this something that can really add value in a portfolio? And so yes, we're the first ones that's actually running a fund in North America running it this way. But if you take a look back, there's a lot of other people that have written about this. I wrote my first book back in 1999 and dealt with the 6-month seasonal period. Some people call it the Halloween effect. Jacobson and Zhang just produced a report back in October of 2012. And it's very informative as far as the 6-month seasonal periods from October into April. They're saying by far that's much better than the other 6 months. We've just entered into what I call the unfavorable 6 months. And Jacobson and Zhang basically say, after studying over 300 years, 108 different countries, they say by far, statistically, that period is actually the best period to be in the market from October, in their case, the end of October to the end of April. And if you have to compare them on a 5-year rolling basis, you tend to find a lot of extra value being added by being in that period. So if you had only 6 months to be invested in the stock market, where would it be? It would be from October into April. This next 6 months, it can go up, it can go down, but it's not as, the risk-reward relationship isn't as strong for your gains as with the 6 months that we've just passed.
So aside from just the historical approach to looking at what happened over those years, you do provide some fundamental analysis on top of just the seasonal side.
Yeah, that was a 6-month cycle that we've gone through, and we also deal with the sectors as well. What we do is we put together the seasonals. We look at the seasonals first and say what sectors should be going up at this time of year, and we'll take a look at the technicals as well to fine tune and some fundamentals as well. So we actually use a combination of all three, but the primary driving factor is definitely the seasonals. And if you take a look at the way that we operate, is from October to May. We tend to be in the market, and then we'll rotate into the sectors. And then once the sector trade's finished, we'll go back into the stock market. But from May into the end of October, we'll be in cash as our core holding and rotate to the different sector opportunities.
Hence the name seasonal rotation.
Absolutely. So we're rotating in between the sectors. When one sector finishes up its trade, we go into another sector that tends to do well at the same time. If you take a look at the 6-month period here, this is actually an important slide right now because a lot of people have been writing about the sell in May and go away. It's been in the news all the time. But just to illustrate the importance of being in the market from October to May, the difference with the 6 months that we're just in just now. If you take a look at big gains and big losses from 1950 all the way until last year, gains greater than 10% have been 26 times in the favorable season, and it's only lost more than 10% 2 times. That's a good ratio. But if you take a look at the unfavorable season from May to October, the gains greater than 10% have only been 8 times, and it's also lost 10% or greater 8 times. In other words, in the 6 months that we're in right now, which I call the unfavorable season, you tend to get fewer big gains, a lot fewer, and you tend to get bigger losses. So this time period is not as friendly as it typically is for the stock market compared to the last 6 months. And if you want to take a look, let's take a look at this, what's happened over the last 3 years, basically, for the S&P 500 here. So what we saw was a correction that took place in the springtime of each year back in 2010, and then the market, we had QE, we had Bernanke come in and hinted QE Jackson Hole on August 26th, and that provided a lot of liquidity to the market, so it ran up. And that's inside that blue box. That blue box represents the unfavorable seasonal periods. And the second one, if you take a look here as well, you saw a correction here that took place in the summertime, and then you saw Operation Twist coming along and to drive the market up. The areas outside the blue boxes are the favorable times, and the areas inside the boxes are the unfavorable times. And in 2012, we saw the market go through some volatility, some correction, then you had Draghi come out and say, we'll do whatever it takes to save Europe, and also the QE3 come to play. The last 6 months, from October 28th to May 5th in 2013, has also been very positive for the S&P 500, up 14.4%. The reason why this slide is important is to say that the market actually corrected at the beginning of the unfavorable season, which we're in now, and then you had some big stimulus event come along and boost the market. A lot of quantitative easing or big promises from Draghi. Well, guess what? This year, the talk is not about increasing stimulus. It's talking about taking it away. So we don't see, after a big run in the market right now, we don't see a lot of stimulus coming in, a lot of action that can actually drive this market substantially higher at this time. In fact, we think the market's actually prone to a correction over the next few months, and without the saving grace of another liquidity injection taking place.
And that's where the economic fundamental side of things take into the equation along with the historical. seasonal trends that's been happening.
Absolutely, we'll make some adjustments on our fundamentals and say we need to make some adjustments because some things are different this year from a macroeconomic standpoint.
Can you talk a little bit about specific examples of what you would invest in during certain seasons?
Sure. Okay. Absolutely. Well, let's take a look at gold. So gold's coming up right now. The seasonal period for gold is from July 12th to October 9th. That tends to be the best time to invest in gold. And this chart here is the average year of gold from 1984 to 2011. That's year on top of a year. Every year looks a little different, but this is the average year. And the reason why gold goes up at this time is because 67% of the gold is consumed in jewelry every year, the amount being produced. And when does the demand take place for that? Well, it actually happens in the fall and early winter. So you got Diwali. The Indians are the biggest consumers of gold in the world. The Diwali, their festival of lights and wedding season. And also even from our own culture. You know, Christmas time is when we give out gold. So, well, how do they store wealth? They don't buy in gold bars. They buy in jewelry. So gold fabricators have to buy the gold in the summertime, which tends to drive the price of gold up. And so you see this gain that tends to take place with gold. In fact, if you take a look over the last 3 years, what you see here is in those boxes of the seasonal period, you can see gold performing extremely well in all three, from 2010, 2011, and 2012. All three times it outperformed the S&P 500, and it produced a large positive gain at the same time. So yes, in the last few times this has worked extremely well in our fund. We are actually long gold, fairly long gold in these time periods, and did profit from this trade. Right now, we're coming up to the window where we possibly could invest in gold because we're a month before the trade. Right now, we don't see the technicals to support stepping into a position, but it is definitely something that we are interested in doing, perhaps in another month or so, based upon the technicals of the time. We think the same fundamentals that have helped in the last 3 years are going to be this year.
Now, can you talk about your view on energy during the times of the month? This is always fascinating to me, and I want our listeners to understand how you in your team view seasonal trading on energy during the summer times and the thesis behind it.
Sure. I mean, energy has 2 seasonal periods, and there's always something that drives the seasonals. For gold, I explained it was because of the supply-demand imbalance, and the same thing happens with the energy sector as well. The kickoff to driving season, which is the big consumption of gasoline and oil, is Memorial Day, which is in May. So seasonal investors tend to want to just get in just before that. But we know better than that. You know, we step in way before that when the market starts picking up and anticipating that. So the best way to be a seasonal investor is to get in before everybody else gets in. And when the event actually occurs, to get out, because you've taken advantage of everybody else getting in. So the big consumption tends to take place in the summer months, and so we'll actually step in February and get out in May. There's another seasonal period in late July into September as well for the energy sector, and that's based upon the heating oil. And it tends to actually perform very well as all of a sudden there's a larger demand for heating oil.
And that's going to be based on how hot the summer is.
It's going to be based on how hot it is summer is, but mainly with the winter time as well. If they're anticipating cold winter, and you see a lot of refineries have to shut down to retool to produce heating oil, and because heating oil is not like gasoline, it's not consumed on a daily basis, they actually need to store a lot of the heating oil, so they actually start to produce it in the late summer. And if you take a look at the sector of the last 2 trades for the energy sector, this is using an ETF in the States. You can take a look from in the summer months. Last summer, you can see a very positive trade that took place, and it was actually in a bullish technical pattern as well. And it outperformed the S&P 500. And more recently, the energy trade, this gives an example that they all don't work. And that's important to say. What we're doing, this is seasonal investing is a long-term discipline, where what you're doing is you're putting the odds on your side. So if the seasonal trade works 80% of the time, that means it's not going to work sometimes. But so if you do enough of these trades, then yeah, sure, one isn't going to work out of 5 of them, or two aren't going to work out of 5, but the other ones are going to more than compensate and help to outperform.
The probability is on your side.
The probability is on our side. That's exactly it, Frank. So that's essentially what seasonal investing is. And you can see here, in this case with energy trade, it was actually positive in its seasonal period, but it underperformed the S&P 500. So we had a trade here that worked in last summer, and because it outperformed and was positive. And this last one did provide a positive performance, but didn't outperform the S&P 500.
Now, can you talk to us a little bit about just the whole fertilizer world, and as an example of how that seasonality comes in, using potash as an example?
Sure, yeah. Potash is, this applies to the other fertilizer stocks as well, Agrium, and also as well, the Mosaic and CF Holdings as well. So there's a few of the fertilizer sectors, but they generally have a seasonal period from the end of June into January. And if you take a look at potash, since 1990, it's actually been positive 86% of the time. It's produced an average rate of return of 23%. That's really good. Now, that doesn't mean it's going to work all the time. But when it works, in fact, the last couple of years where it hasn't worked, but overall, it has worked very well. And because of this track record, it's something that definitely we are looking at this time of year, something we're interested in. And the reason why potash goes up is because of the cash flow that happens in the agricultural business. You find that the farmers generate their money from the harvest that comes in the fall time. One of the first things they do on a good harvest is they spend money to reduce their taxes. Where do they spend their money on? They spend it on fertilizer. Also, grain prices tend to go up at that time of year, which helps to support that. So potash, if you take a look back at 2010, like I'd like to say I could predict everything, but you see the big gap that occurred in potash here in 2010. That was when BHP was trying to buy them out. But even before they were trying to buy them out, the positive seasonality was working for potash. And so that sector trade was stock trade was actually very, very strong this year. In 2011, when the market was getting absolutely crushed, if everybody can remember back to those horrible times, potash was actually outperforming coming into the summer, the fall time into September, outperforming the S&P 500, even though it was going down. But once the market started to really fall apart, it actually sold off. And so we know that the stock has a higher beta, so if the market does get crushed, you're going to actually see that not perform as well. Last year, it actually provided, didn't perform as well as it should either. But this year, we think the technicals has been in a trading range right now, so we think it's actually in a fairly good position for this year.
Now, can you chat about the difference between consumer staples versus consumer discretionaries, and how seasonality, how you approach it from that seasonality perspective?
Sure. This is, the consumer staples, consumer discretionary trade is actually one of my favorite trades. So the trade works like this. You invest in the discretionary sector from October 28th until April 22nd, and you invest in the staple sector in the summer months. So normally the consumer sector is 20%, so instead of being half and half, you put the whole thing in and you rotate like a back and forth. From 1990, if you just invest in the S&P 500 to 2011, it was up 303%, a great return. You can't complain with that. If you just invested in the consumer discretionary sector, it was up 363%. Great trade. And the staple sector was up 441%, even better. But if you actually just rotated between the two sectors, between the consumer staples and consumer discretionary, own one sector, the discretionary, for 6 months, from October into April, and the staples from April into the end of October, went back and forth, just those two trades every year, from 1990 to 2011, you're up 2,079%.
And can you explain why that seasonality is there from the staples? And staples is where, the difference is discretionary is in an area where you have to buy it no matter what happens, kind of like the Loblaws of the world and things like that.
Yeah, absolutely. So the discretionary would be things like cars, where you don't have to buy it, you can hold off on it, versus staples would be, things we have to buy, like, diapers or those types of products, whichever companies focus on those products. So they're not as economically sensitive. So the stock market tends to have a little bit of trouble in the summer, as we talked about earlier on, and the economy tends to also suffer a little bit as well. So the staples, investors are attracted to that segment where it's going to be a more stable income flow from the stocks, because people aren't going to reduce their expenditure like they are with the discretionary sector. Versus the discretionary sector, which does well from October into April, that's when the economy tends to do better, and investors tend to try and see more opportunity as far as the higher beta stocks.
And I guess just from a realistic level, Christmas time rolls around and people are spending more during that time of year. Is that safe to say?
Absolutely, and that's our big expenditure time as well. So people are going to be much more inclined to be spending money and versus the staples, which can be more regular.
Okay, great. So this next graph we have here is actually a comparison of the HAC, which we utilize, which is the ETF for the Horizons seasonal rotational mandate that Brooke and his team manages, compared to the S&P TSX and the S&P 500. And I think the important thing to see here is not necessarily the upside performance, but it's actually the lower volatility that you see on that mandate versus the stock market indices such as the S&P 500 and the TSX here.
Yeah, and you know, if you take a look at the orange line, which is HAC, and versus the TSX, obviously we've outperformed the TSX composite strongly. You know, in the summer months where you see those big drops that have occurred, we've actually been fairly flat and actually rising. In 2011, when the big drop occurred, we were actually going up at that time. So we've had less volatility in the fund because of the nature of the fund, as well as actually performing well at the same time.
I think the important part that you touched on is the fact that it may sound like a short-term strategy, but it's actually a long-term strategy, that you're utilizing historical seasonal performance, what happens during certain parts of the year, and taking advantage of that, and having the being nimble enough to be invested, fully invested, or be nimble enough to be in cash. From our perspective, we manage from an asset allocation perspective, and we don't necessarily have the tools in-house on our end to do that. That's why we rely on Brooke and his team to manage that component from a seasonality perspective. And we actually use HAC as part of our U.S. component because the majority of the investments are predominantly going to be on the U.S. side, correct?
Absolutely, yeah.
So, you know, right now, can you give us a bit of some background on what has happened over the couple of months in your mandate?
Sure. Just to touch back on the point of the fund being, it's a longer-term fund. It's a long-term outlook we have, and so this isn't like a, you know, we're not trying to time the market as we mentioned earlier. And it is a very disciplined strategy. We do have our mandates. We can't go against our mandates. We can't say, oh, gold's not, we're not in the seasonal period for gold, but let's go buy it anyhow because we think it's good. We're very strict on our mandates and following through on our discipline as well. Well, the last couple of months, I can just talk a little bit about what's taken place. And as far as the indicators go, something that's a little bit different that I've been writing about a lot and trying to put forward is the defensive sectors, which we talked about, which would be consumer staples, the utility sector, which is also considered defensive because that's not going to change very much with the economy, and healthcare, naturally, is a defensive sector as well. So these are sectors that people tend to gravitate towards in tough times, when they question the market whether it's doing well. And what we've seen in the last 3 years is we've seen these defensive sectors actually outperform in the springtime, which has actually told us that the market underpinnings aren't that strong, even though the S&P 500 was going up. But that means the market was prone to a correction, which we saw in 2011, which we saw in 2012. This year we haven't seen that correction yet, but we are concerned that we do see this because we've seen this phenomenon take place when the defensive sectors outperformed in the springtime, when they typically do not do that, which means that the market's a little bit concerned. And so right now, the market has been going up, but we do think the market is prone to a correction, perhaps a mid-July time frame as well. So it is possible that does take place.
So did you sell in May?
Sure, absolutely. We reduced, because it's our mandate, we reduced our equities in our holdings substantially and made our portfolio more conservative. And even after that we did that, the market went up a fair bit into, I guess, May 21st and peaked out there about 1670 in the S&P 500. And it's pulled back down to about 1600 at this point. But so yes, we did actually sell a lot our major holdings, run back into cash. Now we're looking into investments in different sectors that are seasonally significant, but we'll probably hold a lot of cash through most of the summer.
Okay, great. Oh, that's excellent presentation. Hopefully our listeners understand the process. I think you've done a great job in explaining the commonsensical approach to investing based on the seasons and the demands. What I want to let listeners know is that if you want to receive Brooke's newsletter on a regular basis, just give us a call, give our office a call, along with his books. I know we've got a couple in the office, so just give our team a call and we'd be more than happy to share that with you. I just want to thank you for joining us today, Brooke, and maybe we'll have you back in here October when it seems like that's start to be the exciting times again. But we really do appreciate your time, and I know that our listeners, our clients out there, appreciate the strategy that you utilize.
Well, thank you very much for having me on the conversation. It's been great, and it's been a pleasure. Thanks, Frank.
Thank you. Thank you, everyone. Thanks for joining us.